The Volatility Surface, a Practitioner's Guide by Jim Gatherell, delves into the complex world of options pricing and the volatility that underpins financial markets. This book addresses the sophisticated models used by practitioners to gauge option prices, manage risk, and understand the deep rooted principles behind market volatility. Here's our pick of top 10 insights from the book. 1. The volatility surface is not flat. It shows a complex, multidimensional shape that reflects various market conditions and investor sentiment. Imagine stepping onto what looks like a calm, flat plane, expecting a leisurely stroll, and suddenly finding yourself on a roller coaster ride through the hills and valleys of the volatility surface. This is no flatland. It's a financial landscape contorted by the collective psychology of market participants. The surface twists and turns, with peaks and troughs representing the frenzy of investor fear and greed. Options traders can't just strap on their seatbelts. They need to be skilled cartographers, mapping this terrain to predict which direction the roller coaster will lurch next. This undulating volatility world is their Disneyland, and they ride it with a mix of terror and exhilaration, hoping to make it out with more than just a photo of their shocked expressions. 2. Implied volatility differs across strike prices and expiration dates, creating the skewed smile or smirk that challenges the Black-Scholes model assumptions. Ah, the infamous volatility smirk. It's the Mona Lisa of the options world. Your friend, the Black-Scholes model, would have you believe that markets are a calm sea of rational behavior, where implied volatility is as flat as a pancake. But no, markets have mood swings, and active traders know this all too well, observing how anxiety and greed curve that volatility into a sardonic grin. As you move across strike prices and expiration dates, the smirk reveals the market's dirty little secret. Risk isn't a one-size-fits-all. The further out of the money you go, the more the market starts whispering or sometimes shouting, "Buckle up because we're not in Kansas anymore." Consider this a treasure map where X marks the spot of mispriced options, but instead of X, it's a wonky smile that might just be winking at you if you know how to decode its mysterious ways. 3. Short-term options often exhibit higher implied volatility than long-term ones, an unintuitive phenomenon known as the term structure of volatility. Strap in, options traders, because we're about to get paradoxical with the term structure of volatility. Counterintuitively, those jittery short-term options are like caffeinated squirrels, showing higher implied volatility compared to their long-term sloth-like cousins. Despite the future being murkier than a fortune teller's crystal ball in a foggy swamp, market players often price short-term contracts with an extra dollop of uncertainty. It's like everyone suddenly becomes a drama queen over what's going to happen tomorrow, but chills out when it comes to predicting the next season of Game of Thrones. So next time you see that volatility curve, remember, in the options world, short-term memory equals big drama. 4. Volatility surfaces evolve dynamically over time, displaying patterns that can be exploited for trading and risk management, but also creating potential pitfalls for models that assume static surfaces. Picture a volatility surface like an ocean surface, subject to the whims of financial weather. One minute it's as placid as a Zen master meditating, the next it's throwing a tantrum like a toddler denied candy. For savvy traders, these tantrums and Zen moments can translate into lucrative opportunities or treacherous traps. Ride the waves with skill, and you might surf your way to profit. Misjudge the tide, and it's a wipeout for your model, which is probably still sunbathing on the static surface of yesteryear. Evolution is key here, folks. Adapt or become financial fossils. 5. The book provides evidence that market events and the leverage effect have significant impacts on the shape and behavior of the volatility surface, indicating a strong link between asset prices and their perceived risk. Ah, the volatility surface, that whimsical creature living in the depths of the financial markets, constantly shape-shifting like a mood ring on the finger of Wall Street. Essentially, this surface tells us how bumpy the ride is going to be with a particular stock or index by plotting expected stock volatility against strike prices and maturities. The punchline? It's not just thrown together by the whims of the market gods. It's more like a dance floor where the dance moves, market events, and even the strength of the dancers' leverage effect create ripples and waves. So next time you're trading options and you see the volatility surface warp like a Salvador Dali painting, remember, it's not just random. It's a complex tango of financial forces at play. Watch those steps. To sum it up, the volatility surface, a practitioner's guide, explores the intricate and dynamic nature of the volatility surface, which challenges traditional financial models by displaying skewness, term structures, and sensitivity to market conditions and events. The guide offers insight into leveraging these characteristics for trading, while cautioning about the dangers of static assumptions in a perpetually evolving market landscape. Thanks for watching, and I hope this summary piques your interest in the nuanced world of financial volatility.